Welcome to the Deep Dive. Our mission today, well, it's to take a stack of sources specifically, some really powerful excerpts from Christopher Leonard's book, The Lords of Easy Money, and pull out the most important, maybe surprising, and frankly, sometimes unsettling insights for you.
That's right. We're diving deep into a really critical look at the Federal Reserve, focusing on those dramatic, often, unconventional monetary policies they've been using, especially since the 2008 crash.
Think of this as your shortcut, your express lane, to understanding some of the huge, often invisible forces shaping our economy. We're really honing in on how decisions made, maybe in quiet boardrooms, ripple out and land squarely in your financial life.
And what Leonard argues, what we're going to really unpack here, is that the Fed's heavy reliance on easy money, things like near zero interest rates, massive interventions, well, it's come with some pretty significant, perhaps unintended consequences.
Yeah, like financial instability, sure, but he also points to growing economic inequality, big picture stuff.
Exactly. He gets into the history, the mechanics, which can be complex, the key players involved, and some genuinely surprising outcomes that he highlights throughout the book.
Ready to dive in, see what's most important from these pages.
Absolutely. It's definitely a thought-provoking read.
Okay, so let's get into it. Leonard kicks off the book with this moment that really sets the stage perfectly. It's about a single significant voice of dissent. He opens in Chapter 1 back in November 2010. It's Thomas Hoenig, who was the president of the Kansas City Fed then, and he's preparing to cast the only dissenting vote against QE2, quantitative easing 2, a huge decision.
And understanding Hoenig's fear right then is, well, it's central to Leonard's whole argument. Hoenig was deeply worried, fundamentally concerned that pumping all this cheap money into the system would create long-term instability.
Right. Not just instability, but also dangerous asset bubbles.
Yes. And critically, that it would widen the gap between the rich and, well, everyone else, increasing income inequality.
He saw it, basically, encouraging Wall Street to take wild risks again, creating this moral hazard, this idea the Fed would always swoop in and clean up the mess. He felt they were, sowing the seeds for future trouble.
And Leonard uses Hoenig's position, his lone stand, as a key narrative thread throughout the book. It represents that cautionary voice that, according to Leonard, was largely ignored or just overpowered by the consensus view inside the Fed at the time.
So despite that warning, QE2 happened. And this brings us to the sheer scale of it all, the mechanics of this easy money approach Leonard details. He calls it serious numbers in one chapter.
Chapter 2, yeah. And later, pretty vividly, a money bomb in Chapter 6.
A money bomb.
Yeah.
So what does that actually mean? How does this QE stuff work?
So QE, quantitative easing, it's basically the Fed massively expanding its balance sheet. Now, a central bank's balance sheet, it's just its assets and liabilities like any company's, but just on a scale that's hard to wrap your head around.
Right.
Through QE, the Fed essentially creates new money, almost like, digitally. It's not printing presses anymore. They use this new money to buy massive amounts of assets, mostly government bonds, mortgage-backed securities, buying them from banks and other big financial players.
So the Fed says, we'll buy trillions of dollars of these bonds and pays by just crediting the bank's accounts.
That's pretty much it, which floods those banks with reserves, basically, cash. The stated goal, the public reason, was clear enough. Lower long-term interest rates, get banks lending more, encourage businesses and people to borrow, and, ultimately goose the economy and get unemployment down after the crisis.
But Leonard jumps right in with the critique there. He argues this tidal wave of money, it didn't really flow into boosting wages or helping average businesses much.
Right. He contends it largely stayed within the financial plumbing. It circulated among banks and investors, bidding up the prices of financial assets, stocks, bonds, etc., and mostly benefiting the people and institutions who already owned those things.
And that connects directly to another key idea he talks about, this concept of green inflation or asset inflation. He discusses it in Chapter 3. It's different from, the price of milk going up.
Exactly. Asset inflation is when things like stocks, real estate, maybe even fine art or crypto, when those prices shoot up way faster than wages or the cost of everyday goods and services.
Yeah, and this is where it gets really interesting and connects right back to you, the listener. Leonard argues that those super low interest rates for years, plus all that QE money sloshing around, well, it pushed investors and companies to take bigger risks.
They could borrow so cheaply, so they plowed money into assets, fueling speculation, and this caused asset prices, maybe the value of your 401k if you have one, or the price of houses to just soar.
And the kicker, as he lays it out, especially in chapters 3, 14, and 15, is that this helps asset owners way more than anyone else. If you've got a big stock portfolio or several properties, great, your wealth balloons. But if you're mostly living paycheck to paycheck, you see housing get more expensive, maybe college tuition, healthcare, but your wages aren't really keeping pace. That's the disparity he points to. That's where the inequality gap widens.
It's a powerful argument about who benefits. Now, moving slightly, Leonard also spends some time looking at how the Fed actually communicates all this. He digs into Fed speak in Chapter 4.
Ah, yes, Fed speak. I've tried reading their statements sometimes. It's dense. You almost feel like you need a secret decoder ring.
Right. It's often deliberately opaque, very technical language. And Leonard's critique is precisely that. He argues it kind of shields what they're doing and the real-world impact of it from the public.
Makes sense. If the language is too complex or just vague, how can the average person, or frankly even a lot of lawmakers, really grasp what's happening and why it matters to them?
And if you can't understand it, well, holding the institution accountable becomes really, really difficult. That lack of transparency, he argues, hinders democratic oversight. It's a barrier.
He also zooms in on the people involved, the power structure. Chapter 5 talks about the influence of key figures, sometimes framing them as overmighty citizens, unelected people with immense power. He mentions Alan Greenspan, the former chairman.
Right, and how Greenspan's emphasis on deregulation deeply shaped the Fed's philosophy for years, setting the stage for some of this.
It definitely raises that fundamental question, doesn't it, about concentrating so much power in an institution that isn't directly elected, but makes decisions that impact absolutely everyone's economic life. What about the democratic legitimacy there?
And he profiles the current chair, Jerome Powell, in Chapter 8. He notes Powell's background, specifically his time at the Carlyle Group, a huge private equity firm, and his involvement in things like leveraged buyouts before he joined the Fed.
Okay, so for listeners, a leveraged buyout, or LBO, is basically when a firm buys another company using a ton of borrowed money. Often involves restructuring, maybe loading the acquired company with debt. Leonard points to Powell's experience here.
And suggests it might shape his perspective, perhaps making him more attuned to, say, the stability of financial markets or the interests of large corporations involved in these kinds of deals compared to other economic concerns.
So it raises questions, potentially, about conflicts of interest.
Leonard notes that those questions have been raised, given the Fed's massive role in overseeing and interacting with the very financial world where Powell built his career. It's part of the picture Leonard paints.
Okay, so diving back into the policies themselves, Leonard calls this extended period of easy money a quantitative quagmire.
Chapter 7, yep.
And the ZRP regime in Chapter 10. ZRP meaning zero interest rate policy. Rates basically at zero for years on end.
And his argument here, in a nutshell, is that relying on QE for so long starts to give you diminishing returns. Like, the first round might have a big impact, but the later rounds, less bang for the buck for the broad economy.
But it creates dependency.
Exactly. The financial markets get hooked on the support. They expect it, so the Fed gets trapped. If they try to pull back, try to unwind these policies, or just raise rates normally, markets can freak out, panic, volatility. He explores this trap in Chapters 7 and 10.
In ZRP itself, those near zero rates, they had real consequences, maybe unintended ones, for specific groups, right?
Oh, absolutely. Think about people living on fixed incomes, savers, retirees, pension funds. They rely on interest from safe investments like bonds or CDs. ZRP essentially wiped out their ability to earn a decent return without taking on more risk.
So it forced them into riskier things, like the stock market, just to get by.
For many, yes. That's highlighted in Chapter 10. It shifted the risk profile for a whole generation of savers.
What's really striking, and he hits this in Chapter 12, is how these measures QE, ZRRP, which started as emergency responses after '08, just became normal, totally normal, as the chapter title says.
That's a crucial point. They weren't temporary bandages. They became standard items in the Fed's toolkit. And this normalization, Leonard argues, reinforces that market dependency we talked about.
Markets just expect the Fed to jump in now, at the first sign of trouble.
Pretty much. Which, paradoxically, might encourage even more risk-taking because institutions feel like there's a safety net underneath them, provided by the central bank.
It feeds that moral hazard idea again. If you think the Fed will bail you out of big losses, you're probably more willing to gamble.
And we saw this play out really dramatically and recently during the COVID crisis in March 2020. Leonard covers this in chapter 13. The Fed's reaction was, well, incredibly fast and absolutely massive.
Unprecedented programs, right?
Yeah.
Including buying corporate bonds directly for the first time.
Yes. Leonard frames that whole response as a kind of invisible bailout, happening so quickly, so complexly, that the public barely registered what was going on. And he argues it was aimed primarily at stabilizing financial markets and helping large corporations.
And his point there is that it disproportionately helped big companies, big investors.
Yeah.
Sometimes even propping up firms that were already struggling before the pandemic hit.
Exactly. Raising those moral hazard concerns yet again. The idea of socializing the losses while the gains remain private.
And because it was so fast and complicated, there wasn't much public debate or scrutiny over these huge deployments of financial firepower.
Right. Now, Leonard argues these policies have kind of seeped through the whole economy, creating what he calls certain symptoms in chapter 14. One symptom he points to is the rise of so-called zombie companies.
Zombie companies, that sounds ominous.
That's a striking term. These are basically firms that don't actually make enough profit from their core business to even cover the interest payments on their debts.
So how do they survive?
They survive only because credit is so incredibly cheap and easy to get, thanks to those low interest rates. They can just keep borrowing to stay afloat. Leonard argues this is really unproductive. It ties up capital, workers, resources that could be going to more dynamic, innovative companies that actually create value.
And the broader symptoms he mentions, that widening inequality we discussed, maybe reduced social mobility, people feeling like the system's rigged. He connects these back to policies that are seen as favoring Wall Street and asset holders over regular working people.
Yeah, he suggests it erodes trust. Trust in economic institutions, maybe even broader societal trust. That's a recurring theme, especially in chapters 14 and 15.
Which leads us squarely into chapter 15, titled Winners and Losers. Pretty direct.
Very direct. And Leonard's conclusion here is pretty blunt, too. He argues the main winners from supported markets, rising asset prices, easily available cheap credit, they've been wealthier people and large institutions, the ones who own the assets and can tap into that cheap debt.
And the losers, or at least those who benefited less.
He contrasts that with lower and middle-income households, people who rely mostly on wages, not investments, people with fewer financial assets. They didn't see the same boost from soaring stock markets, but they did face rising costs for essentials like housing, education, healthcare costs that often outpace their wage growth.
And he connects this perceived unfairness, this economic injustice, to political shifts, too, suggesting it can fuel populist anger, erode confidence in democratic processes, when people feel like the economic game is tilted against them by forces they don't control or understand.
He argues really strongly that we need to start thinking about equity, about fairness, when we make monetary policy decisions. It shouldn't just be about aggregates like GDP or inflation targets.
Okay, so that leads towards his overall conclusion in the final chapter, chapter 16. It sounds quite stark. He mentions a potential long crash and issues a call to action.
Yeah, he basically sums up his view that decades of relying on this easy money playbook haven't made the economy stronger, but actually more fragile, more vulnerable to the next shock, whatever that might be.
And the long crash idea, is that like another 2008?
Not necessarily a sudden, sharp collapse like 2008, more like the possibility of a prolonged period of stagnation, sluggish growth, and persistent inequality if these underlying structural issues created by easy money aren't addressed. A slow burn, maybe.
So what's his call to action, though?
It's really a plea for a fundamental reevaluation. He argues the Fed, and maybe society more broadly, needs to shift focus away from just propping up markets or chasing short-term gains and towards building long-term sustainable economic health and, importantly, more equitable growth that benefits everyone.
And that involves things like more transparency, more accountability.
Definitely. He's a big advocate for making the Fed's actions clearer, holding them more accountable, and getting the public and lawmakers much more engaged in understanding and debating these incredibly powerful policies. It's a strong closing argument for paying attention.
Yeah, it really underscores how these seemingly technical financial decisions have just massive real-world consequences for all of us. Okay, well, let's try and quickly pull this together. Leonard's analysis in The Lords of Easy Money. It's a really, really forceful critique, isn't it, of the Fed's whole strategy over the past, couple of decades. especially that reliance on the unconventional tools.
He makes a very compelling case, I think, that while the goal was stimulus, policies like QE, like ZRP, have actually fueled asset bubbles, encouraged way too much risk-taking, and significantly widened that gap between the wealthy who own assets and average workers who rely on wages.
And the book really hammers home how these emergency measures just became standard operating procedure, creating these dependencies in the markets, maybe making the whole system more fragile, potentially vulnerable to that long crash he talks about.
Yeah, and it forces you to ask some pretty tough questions. Questions about, the sheer power held by unelected officials at the Fed, about how transparent their decisions really are, and ultimately who benefits most from the way monetary policy works right now.
So thinking about what this means for you listening, it really challenges us, doesn't it? To look beyond just the simple headlines about, say, interest rate hikes and see the deeper, longer-term effects of these complex, often quite hidden decisions on how our economy and our society are structured.
It's less about pointing fingers at individuals, I think, and more about understanding the systemic outcomes that Leonard argues have flowed from this particular policy path. The book feels like a wake-up call, really, for all of us to pay more attention, maybe demand more transparency, more accountability from these powerful institutions.
Right. Okay. Here's a final thought, maybe a provocative one for you to chew on. If, as Leonard powerfully suggests, decades of this easy money approach have created such deep problems like inequality, like fragility, what would a truly resilient, a truly equitable economy even look like?
Yeah.
And what kind of maybe radical changes in policy, monetary or otherwise, would we actually need to get there? Something to mull over.
That's a really big question. Well worth pondering.
Indeed. That wraps up our deep dive into Christopher Leonard's The Lords of Easy Money.